So following on from that session, we've now got another panel session entitled Defining and Maintaining a Strong Risk Culture Within Your Organization. Please welcome on stage our next panel, moderated by Alan Locke, Director, Society Advocacy Engagement at the CFA Institute, Vineet Bora, Practice Leader, Wealth Management, Arete Financial Partners, Maggie Hughes, Director, Financial Services Risk, EY, Benjamin Quinlan, CEO, Managing Partner, Quinlan and Associates, and Niall Coburn, Senior Regulatory Intelligence Expert from Thomson Reuters. Alan, over to you.
Good afternoon, everyone. I've been given a very tough panel to manage because of risk culture, and we have a very experienced panelists, and I was amazed by the kind of insight that I have during our pre-session. So, according to a report by Financial Stability Board, culture can be a very complex issue that involve behaviors and attitudes. And a sound risk culture can enhance effective risk management, promote risk-taking, and ensure that emerging risks and risk-taking activities beyond the institutional appetite can be recognized, assessed, and mitigated accordingly. So what exactly defines risk culture and what should be included under its umbrella? Maybe I start with Vineet first.
Thank you. So risk culture can be either something very essential or it could be something really amorphous. I think the most important tenet of a risk culture is about the whole attitude towards risk-taking. Is it about avoiding risk, or is it about managing risk, or is it about seeking risk? And that can also be the case if you're a trader, for instance. It goes beyond attitudes. It also looks into things such as the consequences of going beyond the risk appetite. It also goes into things such as the oversight mechanism and the governance, which ensures that the whole attitudinal system is evolving in keeping with the times. So it's a complex of those three dimensions.
Thank you very much. So to understand it, really, it's just a quick definition of what risk culture is, because, we talk about it, but no one really states in, what it is in a plain term. So as I understand it, it's the culture of the organisation and how it approaches the risks that it has overall its operations. And the most important thing about that is that risk culture drives conduct. And that's why risk culture is really important to understand. Because if you don't get your culture right, and if you don't understand the risks, then the consequences are that bad conduct follows as a result. That could be complaints, that could be enforcement action. So it's really understanding your risks across the whole organisation, but how everyone actually deals with it from the top right down to the ordinary staff.
Maggie?
So when I'm working with my clients around risk culture, I often find it's quite useful to use the analogy of an iceberg to explain what risk culture is. If you like, at the tip of the iceberg, the part that's peeking out above the water is what I refer to as an organisation's visible intent around risk and compliance. It's what the organisation says it does. That can include things such as the tone from the top. It can include your risk appetite statements, your governance frameworks, your compliance policies, your ethics and corporate values, and so forth, and all the training that you might execute in order for people to understand those sorts of things. So it's what your organisation says it does. However, below the surface is a much bigger aspect of risk culture and a much more influential aspect of risk culture as well. And that's what actually takes place. That can include things such as the tone from the middle. It can be the real incentives that people are receiving, both financial and non-financial. It can be the stories that are being told within your organisation about what's valued and what's not valued. It's the type of rewards and motivations that people receive. It's how people perceive how different and sometimes toxic subcultures within an organisation might be allowed to flourish. And so we have these things. We have what an organisation says it does, and then we have what really goes on within the organisation. And I think risk culture is best understood in terms of the shared perceptions and attitudes and beliefs that people have about the difference between an organisation's visible intent and then what is really taking place. The bigger the gap between the two, the bigger the problem.
Ben?
Yeah, I couldn't agree more with that. I think it really boils down to the fundamental way that an organization's DNA is built around risk, the way they view it, the way they perceive it, and the behaviors around it. And I think moving on from that point, or tying into that point, is really related to, on one aspect, you're talking about the top of the iceberg, which is really the policies and everything that, on the face of it, looks like what the organization presents as its risk profile. But underneath that is really around the way that people engage with it. And no matter how many policies or procedures you have in place with anything, whether it be with risk or with talent or with compensation, unless senior management or the organization as a whole is really walking the walk, then the culture itself fails to actually come to life. So.
Great. Having a good understanding of the definition of risk culture, can we now go to the word crowd? Word crowd, please. Yeah. What are the one word that comes to mind with regards to establishing a sound risk culture in a financial institution? Options, please. Okay, so we have trust, accountability, leadership. Let's see whether this will change at the end of this session. Okay. Since risk culture is so important, what are the must-have essential elements that ought to be put in place for sound risk culture to incubate? Maybe I will begin with Neil.
I think if you consider it, although the board is basically responsible for the culture within the organisation, at the end of the day, in order for an effective risk accountability to work, in other words, have you got an effective risk culture within your organisation, you must ensure that the senior management are accountable for the operational decisions that they make. In other words, at the end of the day, are the interests of the organisation aligned with your clients and your customers? If you go into the historic aspect, before the global financial crisis, one could argue that we didn't even have a risk culture. Now we have the term risk culture, yet organisations aren't really understanding what's expected of them and what's required of them in order to ensure that the interests of the organisations are aligned with the clients. So in my mind, it's accountability of the senior management within the organisation.
Maggie?
So when I think about what are the key elements of a really sound risk culture, I think accountability and tone from the top, as Niall has mentioned, is very, very important. And that really has to be driven by the board and senior management. It's not something that risk and compliance or HR can drive. So that is very important. However, I do think increasingly tone from the middle is even more essential. I'll use a bit of an anecdote from my own personal professional experience as a bit of an example. A few years ago, I was inducted as a new joiner into a large firm, and part of that new joiner orientation process, I was sent along to half-a-day training in corporate values, ethics, and those types of things. The training was fantastic. The company had obviously invested heavily in trying to get the right message across. We had a video message from our global CEO. The tone from the top was impeccable. I left the training. I joined my team back on the floor, and my direct line manager came up to me, tapped me on the back and said, "Maggie, how did you enjoy your HR brainwashing session?" Now, that told me everything that I needed to know about the way things were really done around the organisation and what was really being valued and shared. So tone from the middle can erode all of the good that tone from the top is able to do. The final 2 points I'll just make is that risk culture and conduct really needs to be embedded into the heart of business strategy and business planning. It's absolutely essential. It's not a nice to have that should just sit out there on its own. And then the final area, of course, is that talent management needs to really closely be aligned with what your risk culture objectives are. And so that means your incentives, your retention policies, your consequent management activities all need to be closely aligned with the objectives you're trying to achieve.
Yeah, I mean, again, resonating the point of tone from the top, tone from the middle. If I can bring to light another example, even when, I'm sure the room is full of a lot of bankers here, but even when, as individuals, when you go through and you have to train yourselves on the latest AML regulations or the latest CTF compliance regulations, a lot of the delivery is done online, and it's done through modules that you press next, 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 next. You do an exam, you can fail 3 times, there's no consequences, you pass it on your 4th time, and you're an AML expert. Unfortunately, I think that kind of philosophy and the way that risk is delivered divorces senior management from owning that. And the best kind of compliance training I've seen is when a business head is directly in the meeting, delivering that to you with a compliance team and making it their business and not making it the business of compliance. So I'm sure those of you in banking can relate to that. I'm sure many people feel 2 or 3 steps removed from there being a real culture that underlies what an organization is trying to tell you if there is no engagement by senior management to deliver that message.
Quinlan, you want to comment?
Yeah, I just want to add that I think we're putting a lot on people at the top and people in the middle, whereas I think risk management is a responsibility of everybody, particularly the foot soldiers. Can you imagine a battlefield where the soldier is waiting for the platoon leader or worse, the general to set the tone and say fire when clearly they see something right in front of them. So the risk matrix, the risk landscape is constantly changing. I think one of the most important tenets of a good risk culture is to create a sense of awareness in everybody, and then to ensure that they also get a sense of empowerment and accountability and feel responsible to do something about risk. The cheese is moving all the time. If you keep waiting for somebody to tell you that, look, this is how you figure out the cheese moves, then you start to look for it. You can't wait to be told that the cheese has moved, so get out of there and go somewhere else.
Yeah, I'd just like to add to what Vinette said. I think it's a very important point, and it leads on to the fact that how I see it is that organisations expect to be given a prescriptive approach to risk culture. They look to the regulator to serve them their breakfast, their dinner and their lunch without having their own innovation and creating a sense within their own organisation what needs to be done in a most effective way. And it does go to the tone from the top and in the middle, the iceberg theory, which was very good. But it is also all our responsibility as well to do the right thing within our organisation. And as we heard before on the talk before, that to let our organisation know where things are going wrong, because that is all part of risk and part of the culture. You can't be too prescriptive in this area. It's really knowing what is the best outcome for the customer at the end of the day.
So far, I'm hearing that tone from the top as well as the middle is very important, and doing it not just for the sake of doing, but real action with intent behind, as well as preempting and prescribing is not so good versus principle. So let's move on to the other topic, which is talking about what are the key attributes if a sound risk culture is embedded should have. Maybe I should begin with Benjamin.
The key attributes of a sound risk culture. I think fundamentally ownership, accountability. These are definite things that people need to have with them throughout the organization, and that ties into mainly incentives as well. Every risk culture needs to, it's not necessarily about penalizing people that breach any particular risk provision or compliance guideline or framework. It really is also about encouraging people to adopt best practice and standards and behavior. And that really boils back to the first comment I mentioned around your DNA. Too many of the times there is this conflict between for instance, a business and compliance department, it's us versus them. It's compliance, the no team. I think fundamentally it really is around partnership and adopting a common shared mindset that you're not operating in opposition with these teams. They're there to help you, and fundamentally they're not there as a check and balance that you should challenge all the time. Your mindset should evolve in such a way as an organization that they're really there as an absolute last line of defense. Your second line of defense shouldn't be your second, it should be your last. You should never get to your third, so to speak.
Maggie?
Yeah, it's a complex question, and I think there's a couple of indicators for me that an organisation, is really quite mature in its risk culture. I think the first one for me is that our people want to do the right thing even when the rules are unclear. So I guess leading to what Niall said, we can't regulate for everything, and that shouldn't be our objective. And likewise, within our organisations, we can't have policies and procedures that tell our people, everything that they must do. It's not feasible, and it's not what we want. We want people who are capable of thinking for themselves. And when the rules are silent, or where there is, a genuine grey area, and there's plenty of those in the regulations that our people have to interpret every day, as well as, sometimes it's about just exercising good judgment as well. But when that good judgment is required, that they're motivated to genuinely want to do the right thing. And I'm not sure that is always the case in our organisations. And what do I mean by doing the right thing? It means trying to provide the fairest outcome possible for our customers and for our clients and for the market more broadly as well. Another aspect which I think is really important, and I mentioned it briefly earlier, is that we put culture and conduct at the heart of business planning and business development. I think this is essential as well. And so this means that when we're developing up business strategy, that we look at, well, what are our drivers of growth and how could that lead to greater conduct risk for our organisation? What's our product strategy? Which products are we particularly going to emphasise, and how are we going to distribute those to our clients? And again, what are the potential conflicts of interest, for example, that could be generated from that? So when we look at how our businesses we want them to grow, what are the revenue drivers, what are the key markets we want to enter into, what are the challenges does that pose for us in terms of our organisational culture? So if we look at some of the big conduct and culture scandals that we've seen, and in the previous panel they talked quite a lot about Wells Fargo, if they matched up the business strategy and the business ambitions they had around, the growth of cross-selling accounts, for example, they could see that perhaps the motivations and the incentives they were providing were going to create some perverse consequences. Now, when we put conduct and culture at the heart of business strategy, what are we doing as well? We're engaging the front office, because this is the area that they own and this is their domain. So when we're putting conduct and culture at the heart of that conversation, then we're pushing the responsibility for that risk onto the front office as well and engaging them. And I think that that's the final hallmark for me of a really sound risk culture, and that is that the business themselves understand and own their risks in this area.
Thank you, Maggie.
Okay, so just to recap on what the attributes are, like the three attributes I said. The first attribute is this, that in this room you are the leaders of the future. That's what you should not forget. That's the first point, that you are the barometer of your organisation, and that you influence the organisation by the way that you act and that you conduct themselves, just as I do within my organisation. But I had to think about this question that we discussed, and I wrote down 3 points, and they're only very short. The first thing that an organisation really can do is have their culture assessed independently. Instead of actually saying that I'm great or we're great, look what we're doing very well, lead it out and let it be independently assessed. So in other words, get some objectivity to the question. The other thing is, how involved is the audit committee looking at risk culture? Are they involved at all? I think that's a very important area, because you've got to look at what the complaints are, what the feedback is, what the whistleblowing issues are, and what the regulatory enforcement signs are. And thirdly, but also importantly, is actually the feedback from the line managers and the individual staff about their culture. So it's up to you really to say that we want our organisations to improve. we shouldn't have to depend upon what the regulators prescribe or the guidelines. We should be free-thinking enough to know or have the vision of what we want for our organisation.
I just wanted to add, one of the key issues that comes up in risk management in most firms is the belief that it's very binary. You either take risk or you take no risk. And I think if you take no risk, you just end up pushing the risk underground. It's kind of like prohibition in the 30s. They say there was more alcohol sold in the US in the 30s than ever after or before. So it's very important to create the right sense of risk acceptance as well. And it's important, therefore, to define what's the risk appetite and to ensure then that people work within it and know how to evolve the risk appetite as well as the setting changes. One of the other issues that comes up is the absence of clear lines of accountability. Everybody's sort of watching one another, watching over the shoulder. And the trouble then is if everybody is sort of becoming a risk manager, you perhaps then you lose sight of what the real risks are, and you don't know how to manage it because you're all caught up in trying to avoid risk. So it's important to have a framework which says who's responsible, who's accountable, whose job is to be consulted, whose job is it to just be informed. And I think those who are finally accountable are also those who should be empowered to make the right call or the final call.
Great. And we have a very related questions. Can we have the first question from the audience? Okay. Can you turn around a large traditional financial institution without necessarily waiting for the CEO to make the first move? Any takers? Maggie?
Yeah, so I've met with a number of chief risk officers in the last 6 months actually who have expressed some frustration because they've found that risk culture has ended up in their bucket of responsibilities, but without any really clear kind of mandate being given to them from the board or senior management. And so I think when there is the absence of that clear mandate from the top, it is really an enormous challenge, because what can risk in its own right do to change risk culture? I mean, the answer is not a lot, to be honest. This really has to be an organisational-wide initiative. That said, I have seen some impressive work by individual businesses, individual lines of businesses within organisations who felt that they've had a problem and who've wanted to tackle it, and they haven't waited, for a global CEO to bless their activities in doing that. They've gone ahead and made some impressive change.
Well, just to answer this question, we heard before that, about the Wells Fargo issue, and isn't that an example how if they had only adhered to what they were being told about what was happening within the organisation, how risk could have been averted and how issues could have been solved. So I think it is important, yes, and an individual can alert risks, so we've all got a job in that sense, but the Financial Stability Board and all the regulators internationally say that it is up to the board, it's the responsibility of the board to ensure that there is an appropriate risk culture in place, and that must flow down. And the way that flows down is to ensure that there is proper training for staff, that there is proper accountability in the organisation, but most importantly, that the interests of your customers are served.
Thanks.
I think in general it's a virtuous cycle, and the whole cascade as it moves from C-suite right down to working level will eventually flow back up. And a lot of the key risks or best practices are identified on the ground with people facing these problems day to day. So if you can come up with a solution in your day job, well divorced 7 steps from the C-suite, and that message can cascade back up or find its way back up, then that can form the basis of the new way that culture is managed, or potentially the way that risk is communicated down through the organization as an acceptance of new best practice. So I think you definitely can start it prior to a CEO giving the nod.
Thanks. Can we have the first polling questions? So which of the following is the strongest indicator of a sound risk culture in your opinion? So it seems that individual accountability is the most important barometers. At least that's the point of view of our audience. Panelists, any comment on this?
Well, actually, this is reflected in a quote from William Dudley, who is actually the president of the Federal Reserve in New York. And what he said, I believe that the incentives shape behaviour, and behaviour drives culture. If you want a culture that will support your long-term business strategy, you need to align the incentives with the behaviours which will sustain your business in the long term. And so what this is actually saying is that we're all accountable, that the whole of the organisation is accountable, and I think that's what we've said.
Thanks. Okay, let's move on to the next questions. What are the major roadblocks for financial institutions in their quest for solid risk culture environment? Maybe I start with Vinit first.
I think we've covered some of this ground before, but if there is a lack of personal engagement, personal accountability, if you are completely dependent on prescription, on the letter, then there is almost an abdication towards recognizing risks and managing them as they emerge. And it's essential for a risk culture to have that proactive view to the future. Because if you're not aware, then you're not doing anything about the risks that are coming up. Also, I think it leads to a sense of a slowdown in decision making, because there's a sense that if you get it wrong, the consequences would be dire, and that leads to a slowdown in the organization as well. So one of the most important points, I think, is if there's one thing to fix, is to ensure there's an alignment of objectives, to look at the culture of reward and recognition, and to ensure that the stakeholders, not just the client, but the regulators, the community, the shareholders, all of their interests are combined into the reward and recognition framework we have for our people.
Thanks. Maggie?
Yeah, I think what we're seeing very much is that in many of the key markets within Asia, we're seeing that regulatory expectations are definitely increasing around risk culture and conduct. However, nobody is being prescriptive about what needs to be done. So the questions are being asked during regulatory inspections and supervisory visits. However, there's no roadmap being given about what exactly should be being implemented. So, given that specific requirements are unmet, we're seeing that a lot of firms are really struggling to know what to do, and they're struggling to be able to assess their current culture adequately and to be able to identify where problems might exist. Linked to that is, I think, as an industry, we're really struggling to define a useful set of metrics or key risk indicators for culture and conduct. I don't think anyone's getting this right yet. And without those metrics, it's very difficult for us to be able to track and monitor progress, and also to be able to be convincing when we talk about how our culture is changing. We're seeing that there really hasn't been much in the way of culture change programs being implemented, and the culture change programs that have been implemented tend to be limited. They tend to focus on tone from the top style communication messages, training around ethics or corporate values and so forth. So they've been quite limited in scope, and to be honest, they've been limited in effectiveness as well. As I mentioned earlier, when there's too big a gap between the message that you're getting about what your organisation is supposed to be doing and what is actually taking place on the ground, that means that those types of programs can actually do more harm than good. I think the final real challenge is that there's no regulatory burning platform here in the same way that we see for AML or KYC or a number of the other big ticket items that the people in the room here are dealing with on a day-to-day basis. And so that means, yes, financial services perhaps want to do something about this, but the regulator's not saying exactly what they should be doing, and so they're not investing a lot of time and effort into it.
Benjamin?
I think financial organizations, especially if you look at something like large global banks, are inherently very complex, and that creates big challenges when it comes to identifying a culture. And this is really organizational construct and then the governance framework that underlies it. I've heard people come up here today talking about their roles and saying, and I have a dotted reporting line into. Some people have triple reporting lines. Again, a lot of banks are run along product-centric structures. Some banks have stronger regional governance overlays with different power matrices. That organizational construct creates an extremely problematic situation in terms of who owns that risk, who owns that culture, who's driving it. And a lot of the time, especially when reporting lines or ownership is bifurcated or split off in several directions, it's a natural feeling for people to kind of step back and say, this is not 100% my responsibility. And I think the setup of banks themselves create so much internal chaos and problems within the organization, and I think there is a lot of cleaning up that can be done around that.
I'm hearing the lack of transparency in terms of accountability as the key issue here. Let's move on to the second polling questions, please. Okay, which of the following do you think house the weakest link within a modern corporate risk culture?
Show me the money.
Shall we?
I think, you know, we work in financial services. People are still very motivated about profits and compensation. It's just the reality. And when there is a real misalignment with how we're rewarding people, with the values and the attitudes and the behaviours that we're hoping that people will manifest, we're not creating a positive culture within our organisation. So I think some really important questions need to be asked. Are we really rewarding people for manifesting the right culture? What are we doing around the management of consequences when there are significant breaches of what's expected of people? Are we retaining people or looking to recruit people because of their alignment with our values and our organisational culture?
I actually think the issue of compensation in the future, if you align it with risk culture, is going to cause a lot of confusion. At the end of the day, you've got to see it in a straight line. The reason why there is this concern with risk culture within organisations, because it depends upon what is the conduct of the individuals. It's the conduct of the individuals and the penalties that go wrong. Now, if you look at the last few years in enforcement, take LIBOR, take FX exchange scandals, hardly any individuals or senior managers within organisations were held responsible. Not one prosecution in the US from the global financial crisis occurred. So the issue is really, if you want to get your risk culture right, it's not only about the compensation issue. Yes, it's important, but it's about the conduct at the end and whether or not you're acting in the interests of the customers. And you've got to keep your focus on that. Otherwise, this is just like a story that goes on and on.
Ben?
The compensation one I always find very interesting because I guess the overall rationale was the compensation practices before the financial crisis are what led to the excessive risk-taking and mis-selling and so on that we saw that almost caused the collapse of several banks and did cause the collapse of a few. But what you've seen is banks have obviously gravitated so much to the other end of the pendulum and spectrum, and you're now in situations where you have base salaries have been ratcheted up so much for a lot of bankers, and the bonus or variable compensation component has been compressed to the point that people might not even be inspired to take the appropriate level of risks that they need to in their role because there's no additional incentive. So finding that equilibrium point in the compensation debate it's a very touchy but a very important topic. And I think that, again, even when I look at something like compensation design, I think a lot of it has potentially gone in the wrong direction. And you're seeing a lot of people leaving the industry right now, voluntarily packing up and going, although the industry technically pays very well. So it's playing into incentives and the way that, I guess, they go about their jobs and the risks they are supposed to take day to day in their roles.
Thanks. Let's move on to execution. What can be done to improve the current situation? How can we identify, manage, and prevent conflict of interest? And who should take more action? The board of directors, the management, or the regulators? And will putting more accountability on individuals works? Yeah?
See, I think again, where the mistake's being made again is that it's up to the organisation to take responsibility to ensure that they have a proper conflict of interest procedure in place, which flows from the top all the way down. It's about time that you don't look to the regulator to always give you ideas and feed you or give you the milk, as to speak. At the end of the day, organisations have got to take responsibility and have got to, if you like, reinvent themselves to ensure that they've got proper procedures. Because if they don't, they're always going to be looking at what the guidelines have we been able to do this or that. They've got to start to learn on their own and invent their own ethical approach. That's all. I mean, I think as we've discussed, this afternoon, there's hundreds of regulation notes coming out all the time, and the truth is we don't get the time to read them, never mind act on them. So it comes down to what the basics are. What are the ethics of the organisation?
So EY's doing a lot of work across APAC on conflicts of interest. It's a real hot topic in the region at the moment. In terms of ownership, it definitely needs to be business-led. It needs to be the front office, because what are conflicts of interest? Conflicts of interest essentially are inherent to the financial services industry. There's no getting away from them. Conflicts of interest exist whenever there is either an incentive and an opportunity to work to the detriment of your customer or the market, or indeed another aspect of your own business. So when we're looking at conflict of interest, we're looking at business activities, we're looking at how the organisation makes its money, who its customers are, who are the key external organisations that you partner with and interact with. It's looking at the products that you have and how you distribute those products to your clients. And in all of those aspects of your business strategy, conflicts of interest exist. And so the development of a comprehensive register that identifies the business activities and the potential sources of conflict of interest are absolutely key.
Thank you. Ben?
I mean, it's more like a soundbite from my end to kind of conclude my thinking on this topic, but I think roughly $300 billion in fines have been levied on the global banking world since the global financial crisis. 300 billion. 99% of that is because of a cultural problem. All of the scandals, the mis-selling, the LIBOR fixing, whatever it might be, it's not because of a failure of compliance, it's a failure of behavior and people engaging in bad behavior and risky behavior from the outset. The compliance frameworks and whatever don't need to be there. Again, I always struggle with the concept of 3 lines of defense. Why do you even need 3? You should stop at 2, in my view. You shouldn't have to go that far. I understand the concept of it, but really you should only be addressing that primary problem at the very start. And that $300 billion problem for the industry occurred at the first line of defense. It's not a failure of line 2 and 3.
Absolutely. Can we have the question from the audience? We have a very interesting execution-related questions. Culture varies dramatically between organization and individual. And we are referring to subculture, cluster, group. So how do you balance this difference to ensure that the firms are doing the right thing? In other words, how do you actually execute the various steps to ensure that a sound risk culture can still be built despite all these differences? Please.
So I actually think the most important thing is that if you look at international institutions, there's going to be different cultures all around the world. But at the end of the day, it's about accountability and acting ethically in the interest of your clients. Okay, that's all that's required. And then what was just actually said there about the fines and about the conduct of individuals regulation cannot prescribe against wrongdoing. Okay, we can't have like a law or a note for every single thing that happens, and that's what's occurring at the moment. And as I see it, it's really back to basics and ensuring that you're acting ethically in the interest of your clients. And usually, you know what that knows.
Yeah.
You know what that is. So,
Vinod?
Yeah, I think the most, you asked about what changes can various entities make. I think in this respect, what's most important is for the regulators to come back and start to pin accountability on those who stand to profit or benefit the most. That's going to create the sense of empowerment and responsibility. Now, the firms can approach risk and reward in different ways. There are those who want to maximize reward for every unit of risk, and there are those who want to minimize risk for every unit of reward. They're just two different paths to the same end. But I think the most important thing is, regardless of the path you choose, it's important to ensure that you carry the full accountability for that. Putting it in the front office is usually the best way to go. Otherwise, it just falls between stools. You need to have one throat to choke, so to speak.
Due to time constraint, let's go to the word crowd, and after that, followed by a final rounds of statement by the panelists. Word crowd, please. It's the same word crowd as before. We want to see how difference in mindset you guys have changed.
that seems to be.
Yeah. We are making an impact. Okay.
Well, I think as somebody said in a previous session, you need to set a thief to catch a thief. And I think when it comes to risk management, those who take risks are best placed to manage risk.
So I said at the start here, at the end of the day, you cannot have an effective risk culture within the organisation without an effective accountability procedure and be able to map accountability to take responsibility for the conduct within the organisation. So that's the first line, okay?
Maggie?
Accountability is definitely very important, and I think we're seeing that many regulators are in agreement with that. If we look at the senior management regime, if we look at some of the new regulations coming in Hong Kong, for example, personal accountability is a strong theme.
Last but not least, Ben?
Yeah, and I think the issue with accountability also has to come from within. I think what's happened is, again, to go back to my analogy of compliance training, a lot of people I speak to in the industry feel that, well, now I'm personally accountable, and now I feel this sense of almost fear. So it's not driving accountability necessarily through the right ways. It shouldn't be at the last resort. You will be penalized, and that's how you're going to be held accountable. It should be you want to do this, and you are doing this because it is, as Maggie said earlier on, the right thing to do.
The right thing to do. With that, this session came to an end. Shall we give our panelists a round of applause? Thank you.